see, wow, we've got lots of folks joining us this morning. So welcome, everyone. My name's Clark Brown, and I am one of the newer members to the team here at Victory Financial. If you have not had a chance to meet with me yet, although I'm not the younger member of the team. My background, I started in California in financial services, and my career brought me to Athens about 22 years ago. Went to work for a little company here in Athens that does consulting and training with financial advisors, and have spent the better part of the last 22 years traveling around the country and around the world doing just that. And 5 years ago, I joined forces with the team here at Victory, and bringing back all I've learned in my travels, and really excited to have the opportunity to share with you today some helpful information, I think, that can be a resource for you as you navigate the decision around Social Security. So with that, let me go ahead and we'll get started with sharing our presentation. And let's see, get my screen set up. All good so far. Why am I not seeing it? Anyway, I think you can see it. So we're going to talk about a number of things today, but your key takeaways, and you'll want to note these slides, really are 5 strategies all around the decision points for helping you maximize your decision around Social Security. And make no mistake, this is a very important decision. It's $1 million decision for many of you, particularly when you look at this from the standpoint of how it impacts your overall financial situation. And so among the 5 strategies we're going to touch on, first is looking at what your benefit's going to be and checking to make certain that the information is correct on your Social Security statement, and particularly the earnings record. And I'll share with you how you do that. Then identifying what's the optimal time for you to claim to maximize the Social Security benefit. And this is really important if you're married, and it's about coordinating the claiming strategy between the 2 spouses. We're third going to look at strategies around the specifics of those spousal benefits and understanding how the math and the mechanics work. We'll have an example that we can go through to give you an understanding of that. Fourth is strategies around minimizing the tax impact on your Social Security. And fifth is just thinking about it in terms of coordinating with the overall plan and how you're situated for retirement. So our agenda, we'll start first with looking at how Social Security benefits are determined. We'll move to the rules around when you can claim and how those work. We'll look at the specific penalties for claiming early, what it looks like when you claim at full retirement age, and what the Social Security Administration determines is your full retirement age. And we'll look at the credits that come from delaying your claiming strategy and maybe waiting a little bit longer beyond your full retirement age. We'll take a look at the specific rules for spousal benefits, divorced spouse benefits, and survivor benefits as it applies to both divorced spouses and spouses, widows, and widowers. We'll take a look at kind of wrapping this up with what's the future outlook for Social Security. This is on a lot of people's minds because they read the headlines and they say, oh my gosh, Social Security is going bankrupt. But we'll get to the details of that. So first, how do you determine what your Social Security benefit is going to be? Well, it's going to be based on 2 things. First is how much you have earned over your lifetime and paid into the Social Security system, and then when you apply for benefits. And one of the first things to recognize here is Social Security is not a retirement account. It's not like your 401k. There's not a balance sitting there with a bunch of money you've accumulated. Social Security was established as an insurance program. It's to protect people from not having to live in poverty because of old age or disability. Right? So you have been paying an insurance premium essentially along the way, and that qualifies you for a certain benefit. And so all of these are calculations that are going into what your benefit is out of this insurance program. So the best thing to do, right, there's all kinds of calculators online where they'll ask you to go in and put in, well, what do you make? And it'll draw some assumptions and estimate what your Social Security would be. Best thing to do is go to the Social Security Administration's website, ssa.gov, log in and create an account for yourself, and you can see exactly what the benefit statement looks like. Now, they mail these out periodically to people, and you probably have stuck yours in a file folder somewhere. And even this statement at best is an estimate, and I'll explain to you why. When we get to the point where we're helping people through this decision, we'll take the numbers out of this report and get really specific and more accurate estimates of what it can be. So the benefit of setting up this account, and if you haven't done it yet, I would suggest you do it, because there is a scam, if you will. The bad guys on the internet have been running for a few years. As you know, there's been lots of hacks into many databases, and so there's lots of information about all of us floating around out there. And when you go into the ssa.gov to set up your account, it wants to verify who you are. So it asks you some questions that really only you would know. Now, behind the scenes, what they're doing is they're accessing your credit reports, and so they know information. And you'll get a question, you've probably done this before, we'll say, did you have a mortgage with this bank? Or what's the approximate payment on your current car loan? Or did you live at this address, right? Well, knowing that some of that stuff is out there, the bad guys are able to go in to the ssa.gov site and basically set up an account for someone who has not yet done that, right? Now, they're not going to be stealing from you. They're going to be stealing from the Social Security Administration. But here's how it impacts you. What they'll do is they'll file a claim for Social Security early at age 62. They'll set it up for direct deposit into some bank account that they sweep the money out and run off with, right? Money's not coming out of your pocket, it's coming out of Social Security. But you won't discover this until sometime after you file your taxes the following year. And you'll get a notice from the IRS that says, hey, you missed an item on your tax return. You didn't claim income for the Social Security benefit you received last year. And you'll say to yourself, well, I didn't get a Social Security benefit last year. And now you're on this hunt to try and clean this up because the IRS is looking for money. And it puts you in a situation where you got to deal with two government bureaucratic agencies, which do a good job in some instances and maybe are a little bit slower in others, but it's probably not a favorite way to spend time to clean up this mess. So how do you insulate yourself from this potential fraud or scam? Go in and set up your account if you have not done it yet. By doing that, you then now have your user ID that you've set up, your password, using a really strong password. It reduces the likelihood somebody can hack your account. So if you haven't done it, do it. That's your homework assignment number one. So when you get this statement on the very cover, it'll show you right here in the upper right-hand side what your estimated retirement benefit would be at full retirement age. And then you dig into the material and take a look. So how they determine this benefit is they take a look at your earnings record. And on page 3 of this, and I apologize for the small font, but it was about the cleanest copy I could find from the Social Security Administration. But what this is showing is it's 2 columns. And in this particular instance, it's going all the way back to 1976, which for me would have been my first summer job at a Boy Scout summer camp, where I think I made $96 for the entire summer. And in fact, on mine, it shows 1976, total Social Security earnings, $96, and then how much was, and this third column is what your Medicare tax earnings are. But it'll list out all of the reported earnings over your entire career. And you'll see maybe periods where, like for instance, with my wife, when the kids were younger and she was at home and she wasn't working, there were lots of zeros in there. But you want to take a look at this, and I'll tell you why in a minute, to make certain it's accurate. For the most part, it's going to be, but the way the Social Security Administration collects this information, where there's likely to be errors, is if you had periods of self-employment, because the data they pull for that is different than the data they pull if you're just getting a W-2 every year from an employer. So beginning at age 62, they take a look at all of your earnings, and they take out the 35 highest earnings, and they adjust the earnings for inflation. So there's a table and a factor for each year. So my 1976, $96 inflation adjusted today might be, I don't know, 76. Man, we had some pretty good periods of inflation, maybe 230 bucks, who knows? But they make an adjustment for the inflation and then pull out those 35 highest years and break it down to a average indexed monthly earnings amount. That's the acronym AIME. And they take that average index earnings amount and apply it against a formula. And they refer to this formula as bend points. And that's because you get different credits, higher credits for the first few dollars that you earned, and then it tails off after that. But this will calculate what your full retirement benefit, monthly benefit will be based on your full retirement age. Now, that increases each year with a cost of living adjustment. So when they do this at 62, they're assuming a couple of things to come up with that number on the front page. One is they assume you're going to continue until full retirement age. So if it's 67, right, that's another 5 years of earnings. So they factor that in, and they assume you're probably going to be making about the same amount of money over the next 5 years. And they factor in a cost of living adjustment, increasing it 2% each year. So if you actually ended up retiring early, the number's going to be off from the estimate because you don't have those 5 extra years. And so when they pull all those numbers out for the 35 highest years, it's going to pick up some of the lower years earlier in your career. Now, the other thing too is in the instance of my wife, where she's got lots of zeros, right? If she doesn't have 35 years of work experience in there, of numbers in there, those zeros are going to have a pretty significant impact on the average, right? If you remember from school, if you got a couple of zeros on a few of those quizzes or tests, it could really impact your grade, makes it hard to get that 4.0. So the formula they use is, it's graphed out here on the right. And basically for the first $960 of your average indexed monthly earnings, you'll receive 90 cents on the dollar. So 864 bucks. Then for the next $4,825, that's the red line moving up here, you get 32 cents on the dollar. So now that takes your benefit up to 2408. It's the 864 plus the $1,544 difference there on this calculation. And the final leg of this, and this goes all the way out to the maximum earnings average you could have, because each year, if you remember in Social Security, they stop withholding that 6.5 or 6.75% after your earnings get above a certain point. So there's kind of a max out on this. But in this particular instance, we're using somebody who had earnings every year since age 22. Their average index monthly earnings amount is $10,000. Applying this whole formula to it, the last $4,898 is getting a credit of 15 cents. So their total benefit is $3,142.70. And that's how much this worker would receive at full retirement age. So this is the calculation. Again, when you look at your Social Security estimate, it's an estimate because it's making some of those assumptions. First time you look at it, it's assuming you're going to work all the way through to full retirement age and that your income will stay the same. If those things are different, that's going to throw off that estimate in the report. So page 2 breaks it out specifically and shows you what the numbers look like for retiring at different ages. So full retirement age is the top line here in this particular example. These numbers are different than the graph we were just looking at a moment ago. But in this particular instance, this example shows at age 67, the monthly benefit would be $1,986. If they waited until age 70, which is about as long as you can possibly wait, there's no benefit to wait beyond at this age 70, it would increase to $2,463. If they took it early at age 62, it would be reduced to $1,376. It'll also show you what the benefit would be if you were to claim because of a disability. And then there's other survivor benefits for children and spouses who are caring for children as well. But it gives you a really good picture of what that insurance protection looks like for you. So strategy one in maximizing your benefit is think about how they got to that math for the average index monthly earnings. Look at those numbers. Is it accurate? Are they missing anything? And between now and when you retire, would it make sense to continue working to maybe reduce some of the zeros that might be in the calculation, right? Or have higher numbers worked into that average by working until age 66, 67, maybe even 70. All of those things can help improve your benefit because of the way they do the math. So let's take a look at the rules for when you can claim your Social Security benefit. So I think when we were all kids, Social Security benefit was at retirement age at age 65. Of course, going all the way back to the beginning, when they put all this together, and you look at life expectancies, age 65, not that many people actually made it to age 65, or if they did, they didn't make it a whole lot further past that. Today, life expectancies are very different. And as life expectancies have continued to expand, it's changed some of the math for all the assumptions that go into the entire Social Security plan. And so over the years, you've seen them make adjustments. And one of them was they pushed retirement age out to 66, and then they pushed it out to age 67. So depending on when you were born, the year of your birth, if you were born in 1954 or earlier, your full retirement age is 66. That's when you can claim and get the full amount of your primary insurance amount. That was the number we were just calculating a minute ago. If you were born 1960 or later, full retirement age is 67. And then for these 5 years in between, there's a phasing in factor. So you might end up with a full retirement age of 66 in 2 months if you were born in 1955. So you can find your age on here and know when Social Security Administration is deemed that you are eligible for your full retirement benefit. Now, caveat to this, a lot of times people look at the decision to retire and the decision to claim Social Security as being linked, right? I can't retire until I'm eligible for Social Security, or as soon as I retire, I'm going to claim Social Security. And they are not linked. It's really a decision that is two separate things. The decision of when you can retire has to do with what are all the resources you have available to be able to provide the financial security for the rest of your expected lives between you and your spouse, or if you're single, for you, and planning for a cushion there. Because if we just go with average life expectancy, we could undershoot what you actually experience. So we tend to kind of push it out a little bit further. But that's the decision of when do I retire? When have I created enough financial security that work is no longer required? If you continue to do it, it might be because it's a great vocation and you have a passion for it. When you claim Social Security is a different decision. It's about understanding how it integrates into all of those other resources and making certain that you're maximizing what that benefit can be. And the decision point here, oftentimes, and there's a whole world of behavioral finance, it's described as, or behavioral economics, which is the intersection between finance and psychology. And one of the things that we've learned from the researchers over the last 20, 30 years in this, and you may have said, I knew that already, is that as rational as we like to believe we are at making really smart decisions, human beings really are not very rational creatures. We tend to make decisions emotionally and then go back them up with information. And that process in itself is filled with all kinds of flaws and biases of thinking. But one of the things they discuss in this behavioral finance, and this is a good word. This is a $20 word. It's called hyperbolic discounting. Now, basically, it comes back to self-control, and it's that people will tend to discount the future more than they really should, and think more about gratification in the present. Remember those experiments they did with the kids and the plate of marshmallows, right? And they told the kid, if you don't touch a marshmallow, when we come back in 10 minutes after we leave the room, you get as many marshmallows as you want. And there were some kids that had the ability to do that. Some kids that just didn't. They came back in the room, plate was empty, right? I mean, this is akin to that kind of decision making of, I'm going for it right now. And one of the biggest mistakes a lot of people will make around Social Security planning is they are discounting the future. They're not really thinking about what their needs are going to be, and they'll overweight the need for the present. And that puts them into a situation where sometimes they make a poor decision around Social Security. But know that these two things are not absolutely linked. When you retire, when you stop working, and when you claim Social Security, two different decisions. So if you do take it early, right, full retirement age, maybe 66 or 67, there's a penalty associated with taking it early. And this kind of comes down to some pretty simple math, right? The Social Security Administration has made a calculation, an estimate of what they think the life expectancy is for the general population. And I think the number is 86. So they think everybody's going to live to be 86. Well, if your full retirement age is 66 and you're going to live to 86, that's 20 years. 20 years, 12 checks a year, you're going to get 240 checks. If your primary insurance amount is $2,000, right, we can do the math, 240 checks times $2,000. Right? If you retire early at age 62, that's 4 years earlier, you're going to get 4 years of checks sooner. So that's 12 times 4, 48 more checks. Well, if they gave you the $2,000 amount, right, you'd end up with far more money, right? But they don't let you do that. In fact, the math works out almost exactly where that 75% payout of what you should have got at age 62 brings that benefit down to a point where both the person that got it at age 67 and the person that got it at age 62 would have received the same amount over that life expectancy of age 86. Now, a lot of people live past age 86. And so this is thinking about what the future needs could be and not discounting that to say, well, I'm going to get 48 more checks sooner because, I think the whole thing's going to go bankrupt. And I'm probably not even going to live to age 86. Some of those are those emotional gut rationalizations that people are making that may push them into making that choice to go early. And it may be the right choice. There's not one right answer for everybody. There's a number of things you need to look at. And we've got a slide to kind of touch on what those things are. But in many instances, they maybe end up putting themselves in a situation where in the future at age 90 or 95, the cost could be pretty significant. So for folks like me who were born 1960 or after, the benefit amount at 100% doesn't start until age 67. And you can see the penalty schedule is a little bit more severe. So claiming at 62, instead of a 25% penalty, it's a 30% penalty. Now, if you wait and you claim after your full retirement age, you will receive a credit of 8% of the benefit amount for each year that you wait. And they actually break it down to a monthly calculation. So if you wait, 2 months, 3 months, yeah, you'll get a little bit more. Divide 8% by 12, and you can figure out what that additional benefit would be. But for those folks born 1954 or sooner, where their full retirement age is 66, By waiting until age 72, it would increase that benefit amount to 132% of what their primary insurance amount is. Now, that's pretty good. I mean, think about it. Who's going to give you a guaranteed 8% pay raise, right? That's something you might want to look at and think about before you pull the trigger on this. For those at full retirement age 67, because we've got a year later start, we only get 3 years of that 8%, but still 124% of the benefit. So when should you apply for Social Security? Social Security it's got a couple of features to it that make it a really, really important component of everyone's retirement plan. First of all, it's a check from the US government, right? That there is this moral obligation, if nothing else, that the government has entered into a contract with all of us to provide this protection. And, you know, it's the world currency. You can't think of anything that would be safer than getting a check from the US government and a promise from the US government. The second thing is Social Security is set up to adjust for inflation. There's a lot of investments that you can buy to generate income for you, bonds, annuities, and such, but there's none of them that will give you an automatic inflation protection. Now, for those of you who maybe have participated in a pension system, like here in Georgia, the teachers' retirement system, that pension benefit also has an automatic inflation adjustment. That provides so much protection, because while we sit here in a period of pretty low inflation, Social Security Administration is estimating about 2%, right? We have all lived through periods when inflation was a lot higher, interest rates were higher, right? You could say, oh, remember the good old days when you can get a CD at the bank for 14%. Yeah, but inflation was running at 16, right? Your purchasing power was eroding. But to have something that is automatically has that baked into it is pretty important. So you look at, if you collected 10 years of a Social Security benefit of $2,000 and factoring in that 2% cost of living adjustment, 10 years from now, the check would be larger. You'd get pay raises. You'd get $25.85. If we go out to 30 years, the check of $2,000 now has grown to $4,320. And we know we're going to have inflation to deal with. So having that baked in is a really great benefit. Also, you can think about it in terms of cumulative lifetime benefits, how much you're going to get over your entire life. And this is where, when you look at the numbers, you say, yeah, Clark, I guess you're right. This is $1 million decision. Collecting that $2,000 benefit, adjusting that for inflation, you know, a 10-year period, you'd collect nearly $250,000. Over 30 years, it's just over $1 million. So you can see this is a tremendous resource with a lot of cash flow that can help you through retirement. So as I said, there's not one answer that's the right answer for everybody in terms of what should I do for Social Security. But what we tend to see more often than not is that it matters more about how big your first check is from Social Security than when you get your first check, right? And you can see the impact of that when we think about it cumulatively over time, we think about the impact of that cost of living adjustment. Now, it has a compounding impact, and we can take a look at this. If we start with somebody age 62 and they decide to claim that benefit early, their PIA amount is $2,000. That's their primary insurance amount. If they'd waited till full retirement age, they would have got $2,000. But they made that bet. Hey, I'm going to go early because I want to get more checks. As we see, by the time they're 70, there's been some cost of living adjustments. 75, 80, 85, 90, 95. That $1,500 check has now grown to nearly $3,500. Age 100, it's almost $4,000. But this is the impact of waiting, right? At age 70, that $2,000 benefit at PIA, because of the 8% credits, is now $3,242. And now we look at the impact of the cost of living adjustments, that by the time we get out to age 95, it's a difference of nearly $2,500. And by the time we're age 100, it's a difference of nearly $3,000. Now, that's at a point in time in life where at 95, at 100, we've seen all kinds of folks that have been in great health all the way through well into their hundreds. But a lot of times those are the periods where, our healthcare costs are the highest of our life. In fact, I think there's one stat out there that's something like 85% of your lifetime healthcare costs occur like in the final 36 months of life. And so having that guaranteed income coming in, knowing that it's there to be able to pay for some of those costs, could be the cushion that a plan needs to be successful. So what are the factors to consider? One is health status, right? If you clearly have a condition where it's going to be a miracle to be able to, live past just the generally assumed life expectancy the Social Security Administration has made, that may be one thing to weigh in heavily. How does it impact? How does that come through to your life expectancy? What is your need for income? If you haven't saved a lot along the way, and maybe you're at a point where you've got to retire early because of health concerns, and it's not necessarily something that's going to shorten your life expectancy, it's just physically you're not able to do that work anymore. If this is going to be the primary source of income, then that's probably what you're going to need to do. Are you going to plan to work after you claim Social Security? As if you work after you've claimed Social Security, but it's before your full retirement age, there's some things to know about kind of how that gets treated and what the financial impact is. And what are the needs of your survivor? And when we say survivor, this is really important in terms of planning for married couples. Social Security has set up this spousal benefit because when it was established, traditionally, a lot of families had, one income. The dad went off to work every day and mom took care of the kids. So there's a formula built in, even though mom may have been at home those entire 35, 40 years where dad was working, they'll still get a benefit. Now, it's not going to be as much as somebody who was working that entire period, but the survivor benefit may be absolutely critical for that mom, right? Because her benefit is probably going to be significantly less than it. So you got to consider all of these things as well, and consider what you'll be doing with the proceeds. There's some calculations you can go through to establish what's a break-even number, and the break-even number is usually kind of picking an age where it says, if you live to age 84 or 86, that's the break-even point, where if you started early, you're going to collect more money, right? If you live longer, you're going to collect less money. If you're actually not going to be spending your Social Security benefit to live, and that would be a situation where maybe you have accumulated a tremendous amount of financial resources as you move into retirement. You've got lots of financial assets, real estate, a business interest. Quite frankly, the check is going to come in and you're going to slide it over into the savings account and probably move it into your investment account, but it's not going into the checking account to be able to pay bills. In those instances, depending on what your rates of return are in your investment portfolio, that can push that break-even number out maybe even further to age 90. So as I said, there's a lot of different things you need to look at, and there's not really one pat answer. So when to apply for Social Security benefit, just kind of summarizing all this, if you apply early, the benefits start lower and they stay lower for life. And the cost of living adjustments will impact that. The longer you live, the greater that penalty is, and the more the benefit is for looking at taking delayed credits. The decision is going to impact your survivor. So it's not something that you want to do in a vacuum. You have to really look at it in terms of the entire plan for both of you. So I mentioned, what if you claim Social Security at 62, but you continue to work? Well, the idea is this is a retirement benefit. So they don't want to discourage work. But if you're basically going to keep your full-time job and just start to take Social Security, they've built a mechanism in to discourage that. And so in 2021, the target number is $18,960. You could earn $18,960 up to that number. It would have no impact on your Social Security benefit if you claimed early. Now, this is only in those situations where you've claimed before full retirement age. But for every $2 over that, they're going to hold back $1 of your benefit. They're going to adjust this. And when you get into that last year, so full retirement age is 66, age 65, the last 6 months, there's actually, they adjust this calculation a little bit differently. It's like for every $3, they pull back $1. But this can be a problem in that if you wait until the Social Security Administration figures this out, what they do is they just stop the checks from coming until they have got that dollar for every $2 over 18,960. So let's say you retire at age 62. My dad retired at age 62. He did a little bit of consulting work after that, right? And maybe you land a great consulting gig and they're going to pay you $50,000 to go do something for them. If you know that ahead of time, it's a good idea to reach out to the Social Security Administration and say, hey, my earnings are going to be over X, and let them know so that they can make the adjustment early. And it's not that you wait until 12 months later, 10 months later, however long it takes for the computer to kick out the numbers, and then they just go, oh, we're going to stop sending checks until we've recouped all of that. Now, that's just a pragmatic approach and will help in terms of managing cash flow. Recognize that this money doesn't evaporate. It doesn't go away. Effectively, what it does is they're changing the math so that, let's say you retired at age 62, you claimed Social Security early at age 62, and then in that year you got a job where you made more than 18,960. You made a lot of money, and it basically, they reclaimed your entire Social Security benefit for that year. It has the impact of saying, well, you know what? You really didn't claim at 62, you claimed at 63. And they'll go back through and refigure all of those numbers. So if the penalty was 75%, they'll actually refigure it. So the penalty being at whatever the penalty number is at age 63. So it's not like it evaporates. They'll make an adjustment to the overall benefit. But if you want to avoid this earnings test and all of this, wait until full retirement age. And then at full retirement age, you can go off and consulting to your heart's content, or get that job at Lowe's, or whatever it is that you're going to pursue your passion at, and you don't have to worry about that at all. The one third bullet point in here, though, is don't let that be a discouragement to work, because there's so much stuff that comes from work in addition to dollars. That sense of community, that sense of fulfillment, that sense of well-being and wellness that just comes from being engaged. I guess that's if you like your work. So strategy number 2, in terms of maximizing your Social Security benefit, is to really figure out what's the optimal time for you. You need to consider your income needs both now and in the future. Take into consideration your life expectancy and your spouse's life expectancy. So let's take a look at some of the rules around these spousal benefits and survivor benefits. The spousal benefit, as I mentioned earlier, when we set this up, the traditional family often had just one working spouse. And so there was a benefit set up for that spouse that stayed at home to raise the kids and keep the household in order. So the spouse of a worker is entitled to a Social Security claim, and entitled means the worker is eligible and they have filed for the benefit. So in order for you to be able to file for a spousal benefit, your spouse needs to be eligible for a benefit and they need to have filed for the benefit. That's when the spouse can then file for their spousal benefit. Generally, as a rule of thumb, and this is just a rule of thumb, the spousal benefit is going to be about 50% of the benefit of the working spouse. Now, the reason I say generally is because the math they do to get there isn't quite as simple as just take the working spouse's benefit and divide by 2. They've got a couple of steps they go through. And of course, when you claim is going to have an impact on that. So the spouse must be at least 62 in order to be able to claim early. And if they do, on the spousal benefit, if your full retirement age is 66, the penalty isn't 30%, it's 35%. So that's worse than a worker claiming their own benefit at age 62. The spousal benefit is going to be based on what their working spouse's primary insurance's amount is. It's not going to be based on the worker's actual benefit. Okay. Spousal benefit. Did I say that the right way? Spousal. After the words came out of my mouth, I said that sounded confusing to me. If it was to me, it probably was to you. Spousal benefit is based on workers' PIA, not the workers. Yes. Okay. Let me explain that. So, if the working spouse delayed until age 70 to get those credit increases, get 132% of their primary insurance amount. That's not what the spousal benefit is going to be based on. It's going to be based on what the benefit would be at full retirement. So there's no delayed credits on delaying a spousal benefit. So oftentimes, if the spouse is eligible, that means that their worker spouse is eligible and they have filed, no reason to wait, file at full retirement age. In order to be considered a spouse, you need to be married at least a year. So what if the spouse is also entitled to Social Security on their own work record? So in my case, I mentioned my wife was at home when the kids were younger. She does have her own work record. Well, this is where it gets a little complicated, and the rule of thumb of, spousal benefit is 50% doesn't necessarily apply, because they're going to calculate her benefit and then figure out what the difference is between that and 50% of mine. And then that's called the spousal add-on that gets her up to 50%. But there's a couple of wrinkles that can come in here. And as you might imagine, they all have to do with when you claim and if you claim early and how those penalties might come into play. If the spouse's benefit is going to be higher than their other spouse, there is no spousal benefit. So, and if it's going to be higher than 50%, so if you had a dual income family, 2 professionals, 2 business owners, 2 people who were in the workforce for 35 years or more, and their benefits are about the same, there's no spousal benefit. Each person is going to get their own. So let's look at an example. We'll take a couple, Jack and Jill. And Jill was in the workforce, but she was at home a lot, and so had lots of zeros in that calculation. And at her full retirement age, her primary insurance amount is going to be $800 a month. Now, Jack was the primary wage earner in the family, and his primary insurance amount at full retirement age is going to be $2,400. So right now, you could stop and go, hey, Clark, I think I know the answer. I know where you're going. What's Jill's spousal benefit? And you'd say $2,400 divided by 2, it's got to be $1,200, right? Well, that depends. Your thinking's right, but the math is actually a little bit different. So let's assume that Jill files at age 62. She doesn't wait until her full retirement age at 66. Well, we know now there's going to be a penalty that's going to come into this equation. Now, in order for her to file, remember, Jack needs to have filed also in order for her to get a spousal benefit. So looking at the math on this, we know that Jill's own benefit on her $800 is going to get reduced by 25%. So she's only going to get $600 instead of the $800. Then her spousal add-on is going to get reduced by 30% because she's claiming early. So the spousal add-on, they'll do the math this way. They're going to say, all right, Jill's primary insurance amount is $800. Half of Jack's benefit is $1,200. So $800 minus $1,200, right? That's her spousal benefit of $400. But she's claiming early, so she's only going to get 70% of that, which is $280. So the $600 of what she's actually getting after the penalty plus the $280 gives Jill a total benefit of $880, which is a lot less than 50% of Jack's PIA of $1,200. Again, that's starting at age 62. Now we start to look at what's the compounding effect of that over time, and it can be quite significant. So getting the timing down on this right, coordinating the spousal benefit, the spousal claiming strategy, really important step. And that's strategy number 3. You need to coordinate this decision. The maximum lifetime benefits and looking at that is really important. Less income now, right? Maybe the trade-off to get more income later. If you need to get earlier benefits, you're going to get more income now, but you're trading that off for less income later. And it may be a hybrid strategy. And there's a few situations where there's some things that you can do, and these loopholes have been closed out for the most part, but they still exist for a very limited number of people, depending on when they were born. And they exist in situations for people who are planning that are widows or widowers, of some things that you can do different there. So let's look at that survivor benefit and the rules for the spousal benefits and the survivor benefits. So the amount of the survivor benefit is generally going to be whatever the deceased spouse was getting at the time of their death. The way it's going to be calculated is going to depend on 2 things, though. It's when did the deceased spouse originally claim their benefit, the original benefit, and when is the widow or widower claiming their survivor benefit, and that's going to be the actual benefit. So the key points to note here, when the deceased spouse dies, their check stops, okay? They're not going to continue to get that. The surviving spouse is then entitled to the survivor benefit equal to the deceased spouse benefit at the time. Now, if it was less, they're going to just continue to get their own benefit. But if it's more, they're going to switch over to this survivor benefit. The survivor benefit is equal to the deceased spouse benefit at the time of their death. The widower or widower will receive the full survivor benefit if they claimed at their full retirement age or later. If they claimed earlier, some of that penalty math will come into this. Their own benefit is going to stop at that point. So it's not like you're getting your benefit plus the deceased spouse benefit. Deceased spouse benefit stops, and then you're making the decision of which one's higher for me, the survivor benefit or my regular benefit. If I pick the survivor benefit, then my benefit stops. If you're divorced, there is a divorced spouse survivor benefit. Now, what's interesting about this, and this kind of goes back to what I was talking about earlier, that Social Security is not a retirement account. It's not like there's money sitting in a bucket with your name on it. It's an insurance benefit. So whoever qualifies for the benefit can get the benefit. Think about it like your car insurance. And there is a maximum benefit paid for medical injuries, right? And there's a maximum per occurrence, right? But if you're driving your car and you have 2 or 3 passengers and there's a terrible car accident, all the passengers are going to get benefits because of the insurance protection. Same works with Social Security. So in the instance of my father-in-law, who passed away relatively young, he had been married twice. He'd been married first to my wife's dad, or my wife's mom, and they were married for, I think, maybe 20, 22 years. And then he got remarried, and he was married another 13 or 14 years. And at his death, both these women, his widow from the second marriage and his first wife, who he divorced, both qualified for a survivor benefit. And the math is exactly the same. And it doesn't impact either one of them. So conceivably, you could have a serial marrier who, married a bunch of folks, and as long as they were married 10 years, I guess depending on life expectancy, maybe there could be 4 or 5 people in this car potentially, right? That would all qualify for the survivor benefit. But these are the qualifications. The marriage needs to have lasted at least 10 years, and the divorced spouse is currently unmarried. Okay, so this is to get the divorced spouse benefit. The ex-spouse needs to be at least 62. And if the divorce spouse was more than 2 years ago, we don't have to worry about whether the divorced working spouse has actually filed or not. You remember when we were talking about the Jack and Jill example a minute ago, in order for Jill to file, Jack needed to be eligible and he had to have filed. But in a divorce situation, if the divorce was more than 2 years ago, that's not an issue. So for the divorced spouse survivor benefit, it's basically the same as the survivor benefit we were looking at a minute ago. Again, the marriage needs to have lasted at least 10 years, and the widow or widower needs to be currently unmarried, or the remarriage took place after age 60. So, got any single friends? They're in a close relationship, close to age 60, circumstances look like this, they might want to wait, until after their 60th birthday. So strategy number 4 is maximizing your benefits around minimizing taxes. And so how are we doing on time? Oh my gosh, it flies when we're having fun. We've got about 8 minutes left. We don't have enough time to go through all the details on the calculations that go into this. But as your income, your modified adjusted gross income goes up, more and more of your Social Security is subject to taxation. Under a certain level, it's not taxable. State of Georgia, great state to live in. They don't make you pay tax on Social Security. At the first threshold, half of your Social Security can become taxable. And then at the second threshold, up to 85% of your Social Security can become taxable. So you start looking at ways to coordinate other things that you're doing. So, reduce taxable income as much as you can by using tax advantaged or tax smart investment strategies, but not just municipal bonds. Some people think, oh, wait, I'll just put all tax-free bonds. That's actually a number that Social Security pulls back into the calculation to determine what your modified adjusted gross income is. Begin to anticipate things like required minimum distributions from IRAs, which has now been pushed out to age 72. But those big distributions can come out and maybe subject more of your Social Security taxes and otherwise. So you look at things like maybe doing conversions from the traditional IRAs of your rollovers or your 401k and 403b into Roth accounts. Delay Social Security is to reduce the number of years that benefits may be subject to tax, reduce expenses, pay down debt, maybe adopt a simpler lifestyle, be able to manage through lower income levels, but continue to pay attention and manage taxes throughout retirement. A lot of times when people sit down and do tax planning, particularly with their accountant, the equation is about how do I save taxes this year? And sometimes those decisions may look really good for this year, but when you extrapolate it out and you start to look down the road at the impact, such as when required minimum distributions begin, they can have a pretty negative impact at that point. So we tend to look at this and encourage our clients to look at it as it's about minimizing the total amount of your wealth that's going to get lost to taxes over your lifetime. And when you look at it through that lens, right, it's a little bit back to that hyperbolic discounting, right? It's the idea that I'm looking at the big picture here to make certain that the decision I'm making today is going to have a positive impact, or the most positive impact, for the rest of our financial lives, and what we may have in terms of a legacy that we can leave to our children or to the community through philanthropy. Strategy number 5, as I said, you've got to coordinate this by looking at the big picture of everything. So decisions around pensions and pension claiming strategies, what you're doing with your IRAs and your 401ks, the required minimum distributions that you can start to anticipate, things that you could be doing with your investment portfolio, and work, and how work may come into play, and income from work. And so it's necessary to really look at it from a very comprehensive standpoint. There's a lot of tools that you can find online that will maybe do the quick break-even analysis. How long do I have to live in order to make this decision be more beneficial for us? What that doesn't do is look at the entire equation. And so that's what we've probably helped many of you do, and we will help you do. And if you're not yet part of our family, we would welcome the opportunity to help you do that and sit down and take a look at that. But I think that brings me up to the last of our slides. Oh no, I promised you a look into the future, which is just about as good as, well, nothing. But here's what the headlines say, right? We're worried about the future of Social Security. And the graph on the right is showing a red line and a blue line. The red line is showing the amount of income that's coming into Social Security, and that's through all the payroll taxes that are being paid each and every month. And the blue line is the benefit amount that is being paid out. And you can see we go back to 2009, and that is where the blue line eclipsed the red line. And we're at a point now where if there aren't any adjustments made to the funding of Social Security, the benefits paid out, et cetera, we're going to reach a point somewhere around 2035, 2036, and this number moves around, where there's not going to be enough cash flow coming in to sustain the benefits being paid out. And they're estimating it's roughly about 80%, right? So if Congress, the government, did nothing about this problem at all and just let this rock keep rolling down the hill the way it is, what it means is that Social Security would have to cut everybody's benefits by 20%. You'd still get 80%. So it's not going to go away. And the problem would continue to get worse. And by 2092, the benefit amount would be reduced to 74%. Now, they're taking into account all of those cost of living adjustments, all of those other things. So it's reducing whatever that benefit would be. Well, I just can't imagine what the streets would look like when our congressmen come home and tell us that they failed to deliver on this. And there's a lot of work being done right now to try and figure out how to solve this. One of the pieces of potential legislation that's floating around out there is the Social Security Act 2100, 2100 being the year 2100. And among the things that they are proposing it would do is, first, it would increase that first bend point. If you remember all the way back when we were looking at the first $960, you get 90% of that. They'd actually increase that to 93. And I didn't touch on this, but you can see the reason for those bend points is that Social Security, it overweights the benefit to lower income people than to higher income earners. So this is, in an effort to fight poverty and make certain that people have enough cash flow to be able to live life with dignity in their old age, or if they suffer a disability. This is within the spirit and the theme of what this insurance protection is all about. They're thinking about making an adjustment to how they calculate the cost of living. And this would actually increase those cost of living adjustments based on the index they currently use. They would increase create a special minimum primary insurance amount, would replace the current taxation threshold to $50,000 for individuals. Those taxation thresholds I talked about have not been adjusted for inflation. They're the numbers that they put in when they first passed that legislature a couple of decades ago. It'd be $100,000 for couples. They would, where now Social Security withholding stops when you hit a certain level of income, they would leave that in place. But then when income went over $400,000. So for our, our top 2%, 5%, whatever it is of wage earners in the country, they would have to start paying back into the system. So that would bring money in. They would gradually increase the payroll tax from 12.4%. So that's actually 6.2 is what's withheld from our paychecks if you're a W-2 employee, and then your employer puts in the other 6.2. If you're self-employed, you put in the whole 12.4. So you know that number intimately. It would increase that gradually between now and 2042. And these changes, you can see where we've got this trajectory line today, where we're getting out to 2035, and this is the crisis point where we'd only be able to pay 80% of the benefit. It would put us on this trajectory line of the red dotted line, where we'd be well away from any point where they would have to look at reduced benefits. So what do they come up with? I'm not certain, but that indeed is some of the work that's going on. So you have questions, we stand ready to help. We can help you think through some of these things, when you need to apply, how it impacts if you keep working. What if you've already applied? And there are some things that you can do if you've already started and want to make some adjustments. Understanding what your benefit is going to be and how to coordinate the spousal benefits, and figuring out really what's going to be the best long-term strategy. So with that, I'll check with my counterpart, Betsy, who's been producing this in the back end. Betsy, what questions did we have come up in the chat, if any?
We have several great questions, and if anybody needs to drop off for time constraints, I just want to let you know a couple things before you go. First, our next webinar will be June 22nd, and that will be business planning led by our CEO, Deanne Rosso. Secondly, Clark is going to be leading a retirement planning today workshop in May, and he's going to do 2 different workshops. One will be May 6th and 13th. There are 2 hours each and a 4-hour total. It runs from 6 to 8 p.m. And then the second group will be May 12th and 19th, also 2 2-hour sessions from 6 to 8 p.m. So if you'd like more information about either of those workshops, please reach out to me at marketing@vickeryfinancial.com. And if you want to see our whole list of webinars, our website at vickery.com and click on the webinar link. Okay, so here we go. Great questions from everybody. Thank you so much. First, we have a 2-part question. Did I understand you to say after full retirement age that I can earn as much as I want to without any penalty? And the second part of that is, what if I work 6 months in 2022 and earn $30,000, but then I stop working and turn Social Security on? Am I penalized in 2022 for the money I earned earlier that year?
So first, answer the first question is yes. Once you're past full retirement age, go sign that $1 million contract. You can make as much money as you want. It's not going to have any impact on your Social Security benefit, other than potentially what the taxes are that are going to be paid. Second question was, and it would depend on, and Betsy, did they say how old they are or when their full retirement age is in that question?
No, they did not say, but I'm assuming it would probably be on the younger side, like taking it early. But if you want to type in that age, go ahead.
So as I said, if you're past full retirement age, it doesn't make a difference. If you're approaching full retirement age, let me take a look at my cheat sheet, impact of work. So during the year that you're going to reach full retirement age, the formula changes from withholding $1 for every $2 you earn over whatever the number was we had on the slide. I think it was 19,640 or something like that. It changes to $1 for every $3, and the number goes up to 40. This has actually probably been adjusted for inflation, probably somewhere around $47,000 or $48,000. I'm looking at a number that says $45,360, and I know this is 2 years old. So that's been adjusted for inflation. So you were pretty close there. What was the number, 50,000?
Well, he said, first of all, he's not full retirement age. Second of all, he said if you earned $30,000 in 2022 and then stopped working in the first 6 months and then stopped working and then turned Social Security on.
And so if he's in the year when he is going to reach full retirement age, the number goes from that $19,000 figure up to 46,000, somewhere in that neighborhood. If it's below that, so full retirement age is 67. In that year that you're 66, you get that one benefit, 3-to-1 versus 2-to-1 in the holdback. But at 65, 64, 63, 62, it's going to be for every $2 over the 19,600 figure, they're going to withhold $1. So if in the first 6 months you earned 30,000, did you claim Social Security? Were you receiving Social Security during that while you were earning that? Is that what it sounds like it's in the question? Or did Social Security start after?
You would turn it on after the first 6 months.
Probably need to take a closer look at that. I don't know that I have all the information off the top of my head to answer that one. So can we leave it with, we'll come back to you.
Absolutely, we will do that. Sure.
Things rattling around in my head.
What are my options if I already claim my Social Security benefit, but your wonderful presentation today is making me question that decision?
So if you've claimed early and you're thinking to yourself, maybe that wasn't what I should have done, you have 12 months for a do-over. So if you've claimed in, say, May 1st, 2020, right, you have up until 3 or 4 more days left where you could go to the Social Security Administration and file a stop. And you need to pay back what they've paid you thus far. But you have 12 months for a do-over. Once you get past that, you're locked in until you reach full retirement age. Then once you reach full retirement age, there are some things you can do differently. So you might say, well, gosh, I'm going to suspend now, and they'll take whatever that amount is, and you'll earn 8% credits by waiting from then until, say, age 70 or 69 or 68. So there are some things you can do, but you get that 12-month do-over on an early retirement decision. But once you're past the 12, you're kind of locked in until full retirement age.
Okay. Is there a maximum that Social Security will pay a couple each month? If so, what is that figure?
There's something referred to as a family maximum, and that comes into play typically if you have multiple beneficiaries coming off of a situation where, if you have a late life child, or you adopted maybe one of your grandchildren, when you are collecting Social Security, if they are under age 18, they can get a benefit. And that's back on page 2 in your Social Security Administration. That's when it was spelling out all those family benefits. So they would be entitled to a benefit. Well, the family benefit comes in when you've got like maybe 3 or 4 checks going out for potential benefits. And those numbers are something like either 150 or 175. But as far as a married couple, no maximum benefit. It's just whatever the formulas work out to be for each of your benefits.
Very good. All right, you mentioned the exercise to go through to find your break-even number. Where is that, or what do I have to do to figure that out?
Well, there's a number of calculators online. Some are good, some are not so good. The best way to look at it is in the context of everything else. And that's some of the work that we can help people look at. Because as I said, there's really about 5 different ways to approach it. One that often gets missed is in situations where somebody has lots of financial resources. And they're not, like I said, the Social Security check is not going into the checking account to pay bills. It's going into the Schwab account or the Merrill Lynch account or wherever. It's in those instances where it can get a little more complicated because you need to kind of build in some assumptions of what your return on investment is. And that often pushes that break even out further. But I don't have any recommendations to a good, cheap, free break-even calculator because I don't think they're all that good. I've got our tools that we use, and as I said, we're happy to help.
Okay, and this one says, excuse me if you covered this, but if a spouse passes, the remainder goes to the surviving spouse. What happens when that person passes? Does it go to children or other beneficiaries?
Got it. So again, think about this as it's not an account with a pot full of money with your name on it. It's an insurance benefit. And so like an insurance contract, it spells out who gets what and under what scenarios, what situations. So the benefit is to protect the worker who paid into it and their spouse for that survivor benefit, right? And then there's other protections in there for disability or children, things like that. But there's not a residual balance or a residual amount. It's when the worker spouse passes away and the non-working spouse gets a survivor benefit, they will collect it until they pass away, and then the benefit ends.
Very good. As a couple, our earning history is complicated. How can we decide what is the best strategy for us as a couple? Should we sit down with our CPA, with our advisor at Vickery, or both?
Well, depending on how complicated it is, both. And certainly when it comes to tax planning, we work closely with our clients' advisors, and we'll share with them the analysis, and we rely on the CPA to, validate the tax implications, because they're the ones who are going to prepare the return for you, right? So coordination and teaming is really, really important.
All right, those are all of our questions. And if there's something that you wanted to ask Clark, please feel free to reach out directly to him. And it's cbrown@vickeryfinancial.com. I'm Betsy, and my email address is marketing@vickeryfinancial.com. If you have any other questions, I will send out a link to the recording for this presentation. So if there's anything that you wanted to review or go back to, or if you wanted to share with any family or friends, you'll be able to do that. And again, be sure to look at our list of webinars on our website.
Excellent. Thank you, Betsy. Great job.
Thank you, everybody, for attending, and we'll see you soon.